G'day traders, Stacy Burke from Stacy Burke Trading. Today talking about the opening ranges for the week and for the month, and then tying that back into our weekly levels with our hourly charts, and then of course the important times of days that we've covered in other videos. So as we've mentioned in other videos, the first session of a time frame is usually considered the opening range, and the first couple of bars of any time frame could be considered what's called the initial balance if you read more on Market Profile, Dalton. And if we look at we talked about this in other charts. On this is the Japanese yen. The gray lines represent the Fridays, so that's the close of the week. So the first couple of bars, Monday, Tuesday, in this particular case, Tuesday was the low of the week if we went back here and drew a line. Monday was the selling high of the week, and again the previous week the Monday was the low of the week, and in this particular case the Monday was the buying low of the week. It was violated on the Friday, but it still remained intact until the end of the week. And again, you can go through any of your charts. Monday, Tuesday, got a Tuesday high here and a Wednesday, Thursday low, and Monday low for the week. And in this particular case, we have a Monday, Tuesday breakout, Wednesday high, and again what they would term an open auction. So it auctioned to one side and the extreme and did a measured move to the other side. My point that I'm trying to make here is that roughly 80% of the time, Monday or Tuesday will often act as an extreme for the week in terms of the selling high or buying low extreme for the week. Now, Tuesday in this particular session, so again, I'm just going through randomly marking these off. Again, Monday was the high for the week. If you can start to apply some of this with your other technical expertise, we've talked about the important times of days in the other video. And the point I'm trying to make here is that 80% of the time, Monday or Tuesday may act as a selling or buying extreme for that particular week. Now, if we talk about the average true range for the week, for example, if we look at the Japanese yen, the average ATR for the last 20 days is approximately 66 pips. Sorry, we'll go to the weekly. The average weekly ATR, which is slowly on the decline, is in the area of 150 pips for the week. Now, obviously, every pair is going to be different. So if we understand the ATR for the week, I've talked about marking off the weekly swing highs and swing lows as being significant levels. So whatever the most recent swing highs, swing lows are. Then I also mark off weekly highs and lows. So in this particular case, these two swing highs and lows acted as the same. This swing low was taken out. Weekly low was the previous Friday, and the week high was the Monday. When the week starts to trade, I will often run a scan on Friday with my Metastock. I look for a Friday bar that's potentially closed out of the range or out of balance, or if the market has indeed just stayed within that Monday to Friday range. So for example, this particular Monday opened up out of range of the previous week, but it auctioned back into the range, came up to a supply level Monday, Tuesday, and then turned on Tuesday's high into that supply range and reversed back down towards the Monday opening area, and then on the following Monday auctioned down to the low of that range. So again, this week on the yen, we on the Monday took out that low. The market at some point turned, reversed, came back up inside of the range, and then on the Wednesday auctioned back up towards the opening part of Monday. Now again, we won't get into this specifically, but 50% levels. So if we looked at this again from the start, we had our weekly highs and lows marked off. And once Wednesday, even Tuesday has printed, we know that from that leg down from the previous week, we're closing at 50% of the range. On Wednesday's bar, we now potentially have a weekly low in place. We're back inside of the range from the previous week's session. So if we have a high probability that 80% of the time Monday or Tuesday may be acting as a high or low for the week, we may want to go to our hourly charts to see what happens on the open of the Asia session or even into London. So if we were just trading London, again, we see the market bounce off of that level from the previous week's low, auction back up towards the Tuesday high, did not take it out. The market, as we went into the London Open, auctioned around that level but stayed above the breakout candle from Asia. So the market bounced off that weekly level, reversed on the Asia Open, came back up into the supply zone, came back in the London Open, bounced off the breakout from the Asia session. And again, we talked about the important times of day. If we were to mark those out, the US Open. So we talk about the pre-market is either the trap or the trade. And the market open in this particular case was a first bar breakout trade. But what's mostly important that gives you the confidence to look for these types of setups is knowing that the market came out of range, reversed, and again we know that Monday, Tuesday, there's a high probability that one of those will act as a higher low for the week. And if we take again our highs and lows and our 50% levels, we know that Monday, Tuesday's range, we're into the US Open, we're above 50% of that opening range. So there's a high probability that the market may continue to auction back up towards Monday's high and do a measured move and then go back into the previous week's range. But again, the number one thing to emphasize in this particular case, regardless of what you think or where you're getting in, you can take a 1R stop loss on this trade. Some traders may have shorted this in the London Open. Again, they may have looked to take profits in that gap, but their stop would have been 1R, one candle up here. And again, US Open, that reversal, the minimum that you'd be looking for is a measured move, if it breaks out, is of the range from the London Open to the US Open. So keep it simple, but looking at the bigger picture is the opening range again. So we look at the opening range to give us or help us identify potentially the highest possibility trade setups. Now, if you understand again the profile, once the market broke out on Thursday and cleared that 50% level, there's a high probability again that it would head towards the other side of the bracket, up towards the highs, or at least the supply zone area around that 111.20 area. But the opening range can give you some powerful setups to identify potential turning points or continuation zones on the end of day ranges. So mark off your levels, be patient, wait for your best trade setups. Don't try to trade every single day. Some weeks they're going to be momentum trades. Remember, there are three things that the markets will do. They will break out, consolidate, fill more orders, and continue. They will break out, reverse, and run to the other side of the range, similar to this, which we would call a false break. Okay, and there'll be other weeks where the market will break out, pull back, and go into a trading range. Okay, and most importantly with any of that is just, if you look at your opening range and your weekly levels, it can give you a high possibility opportunity to participate in a asymmetrical risk reward trade setup, where you can position yourself with a 1R stop and maybe be looking at 3 or 4 or 5R as a potential target, and in some cases maybe more. So hopefully you got some value out of today's video, traders. Opening range, and again, even with the first couple bars of the month, 80% of the time, the first couple of bars may help you identify a buying or selling extreme for that monthly ATR, or for at least the first few weeks. And also just understanding where a market opens up in relation to the previous month's the previous month's range also gives you an idea if it's still inside of a range. So in this particular case, if we look at the beginning of May, the first bar, which we could have translated really into the Monday bar, in this particular case, that's one big bull candle. We saw that that low acted as a buying area of support. And if we go over to the first bar of the month for June, again, we see that candle opened up inside of that previous month's range. So we can see that the high and the low of that month can potentially act as a bracket for buying and selling, and also the 50% levels. So we can see the market auctioned around that, eventually found a bit of buying strength, found support, continued, and then broke out of that previous month's range, which if we measure this would most likely be a measured move of that smaller rectangle, which we saw it did approximately 1.25 expansions of that range. So again, opening range traders, study it. It can help you, especially if you're trading intraday, for looking for significant levels of support and resistance. Stay disciplined, stay focused, keep it simple, predefine your risk, and may the markets go with you.
Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, The 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.